All right, thanks everyone for joining. It's the morning of June 24th. I'm Eric Wallerstein. Ed is out on vacation in Scotland, where hopefully it's not sweltering heat like it is here in New York City, at least. So we're going to get started. I'm going to review some of what Ed wrote this weekend about the stock market potential melt up that we're experiencing. I also wanted to briefly touch on the week ahead. Everyone's really focused on Friday's PCE print. But we actually think, the big print this week could be jobless claims on Thursday. CPI and PPI, which feed into the deflator, both came in softer than expected. So, we're expecting a good print. Around 2.6% is what the Cleveland Fed has right now. And we think, everyone should be feeling pretty good that we're making progress toward the Fed's 2% target. The question is how much of that is already baked in? Is the market discounting that already? But something interesting in jobless claims is we've had a little bit more movement. We had 3 weeks of increases before we had about a 5K decrease last week. I mean, if we get above 250,000 in weekly initial claims, that could actually, get the Fed put really revving up. The 10-year Treasury would probably drop from about 4.25 where it is now, break below 4.2%. Maybe stocks would rally on hopes for the Fed put and price in some more Fed cuts. But we don't think that's likely to happen. We're expecting, more sanguine jobless claims numbers for the summer. And something interesting we were looking at is, I'm sure many of you heard of the SOM rule, which takes moving averages of the unemployment rate to try and forecast when there will be a recession. We definitely have a lot of issues with that rule, but one thing that we've been looking at is within the jobless claims data, there's actually a weekly unemployment rate based on people who are claiming unemployment insurance, and using the SOM rule or plugging that number into the SOM rule, we're actually at 0.0%. So we're nowhere near triggering this recession indicator that, the former Fed economist Claudia Sahm came up with. So we're expecting good stuff for unemployment for the week. And it'll be interesting to see how things shake out with PCE. But again, we're expecting something pretty comfortable and still expecting 2% on PCE by the end of the year. I'm going to open up the chart pack and we'll get into markets. Sharing, hopefully you can all see that because I can't. There we go. All right, I think you can all see the screen. Yeah, we should be good. All right. So something interesting that's been going on is a wave of strategists have been upping their S&P 500 targets for the end of the year. We had, I think even ISI went from 4,600 to like 6,000 in the past couple of weeks. We're not going to raise our target. We started out the year at 5,400. And back in January, that was actually at the very high end of strategist estimates. So it's not an interesting analog is actually last year. Ed came into the year thinking 4,600, and we got there by the end of July. And then from July through October, the 10-year yield went from 3.75% to 5% just within 3 months by the end of October. And stocks dropped like 500 points. And then we had a big fourth quarter rally in November and December from, the Treasury and the Fed, they both pivoted policy to a little bit easier. The 10-year yield dropped again, and we shook out the year around 47.50. So back closer to the target or slightly outpacing it. So we're not going to raise it. I think a lot of the people who are raising it towards 6,000 think, that melt up could be followed by a meltdown. Which is definitely possible. We're getting we had an earnings driven market, and we're starting to see a valuation driven market as well. So a combination of both. But that said, if there was a meltdown, we think a 10 to 20% correction pretty quickly instead of, something like a prolonged bear market would be much more likely. A big reason is because the Fed put is kind of back. As we get towards 2%, the Fed can flip towards the other side of their mandate, which is unemployment, and they'll probably preemptively cut rates to try and navigate that elusive soft landing. But I think real quick, we'll walk through, how we kind of, reach our estimates, what we're looking at for the next couple of years, and then we'll talk tech and analog to, the NVIDIA's crazy gains to what happened in the 90s and think, could we get a repeat of that 1990s market melt up, or are things a little different now? So something interesting for this quarter is we're not seeing the typical like downward revisions heading into earnings season that you see. In Q1, for instance, analysts got down to just expecting 1.2% growth in earnings per share. And then we shook out with a 6 handle and nearly a 7 handle quarter over quarter on a seasonally adjusted annual rate. So in Q2, they actually just been keeping their forecast steady, probably not trying to be too bearish heading into earnings season as they were last quarter. Let's go down a little bit. So when we build our forward EPS estimate, we're typically asking ourselves the question, okay, what are analysts going to project for the year ahead by the end of the year? So we're at, for just earnings per share, we're at 250 for this year, 270 for next year, and then 300 for 2026. And then as we get closer to 2025, we start to price in more and more of those earnings expectations. So our forward earnings estimate has been climbing. It's at a record high of $261 per share. And that's getting very close to our end of year target of 270. And you can see just how big of a jump this year to next year is. Analysts expecting double-digit earnings growth for the next few years. So definitely quite bullish. And forward earnings, they tend to track operating earnings pretty well. They're highly correlated. The one thing that forward earnings tend to miss is recessions, and then operating earnings obviously dip, and forward earnings have to get quickly revised or earnings expectations get quickly revised to match that. The reason we're going with forward earnings and we still think 270 and then 300 next year makes sense is because we don't see a recession. The roaring 2020s are still our base case scenario that we have a 60% subjective probability to, really driven by strong productivity growth, which will not only keep a lid on inflation, but drive profit margins wider and keep real wages growing and keep the consumer consuming, which is what they do best. You can see our revenues per share estimates and then operating margins. So something that's pretty interesting about profit margins is they're obviously very cyclical. I think that's how we think about profit margins. But you start to see, since the great financial crisis, an upward trend and then some kind of volatility around that. So I think, and this is part of the roaring 2020s, that as automation and some of this is AI, it's also robotics, as these technologies look to fill the big gap in skilled labor where there's definitely a shortage, companies are getting more productive and they're able to keep costs down with technology, and that really supports earnings even when revenue growth is not as strong. So we're pretty close to consensus, but by 2026 we're looking at 14.5% profit margins, which is all-time record high, or it will be if we get there. And you can see right here forward earnings and actual earnings, which are in blue, tracking pretty closely. And we're still on track for that 270 target by the end of the year. So the difficult thing is it's not where are analysts projecting earnings from a bottom-up perspective, but what multiple do we tie to those earnings estimates? So you can see the band that Ed put on for the rest of the decade, which is a 16 forward PE on the low end, or 20 forward PE on the high end. And so we got to 5,400 by the end of the year by taking 270 and then tacking on the 20. But as you can see, even that, which was wildly bullish at the beginning of the year, hasn't been bullish enough. And now we're above a 21 forward PE, and that's driven the index up towards 5,500. Could we get above 20? Certainly. We were pretty recently. And as we'll see soon, during the dot-com bubble, we were way above 20. And then 16, we briefly dipped below towards 15 in 2022. So a lot hinges on these PE estimates. I think, we think 20 and being above 20 is part of the reason we're not racing to raise our target when, we think that's a little, or it's definitely the top end of what, the expected range should be for the coming years. And so for an analog to why we're at that forward PE, I think it's great that the 90s, well, it's not great that the 90s ended the way they did, but it's a really good analog to look back to think, what does a tech-led market meltup look like? What type of valuations should we be thinking about? What's too ebullient? What makes sense? And what's different today, versus the 1990s? So first of all, we can look at the forward PE for both the index level and infotech. The S&P 500 got to 24 and a half back in August of 1999, which was the cycle peak, and then obviously collapsed. But as you can see, so we're only at 20 or 21 right now, which is well below, but infotech is nowhere near kind of the crazy valuations it was reaching around 45. Or I think it even got farther towards 48 back in 2000. We're only at 30 right now, which it's just a smaller gap. So either it makes more sense or it just makes less nonsense than it did back in the late 90s. And one thing that's different about this cycle is just how much of it has also been earnings driven. You can see back in 2000, forward earnings only got to about 24 for infotech and communication services combined, whereas their forward PE just absolutely jumped, making their market value a huge part of the index, upwards of 40, which is where it is today, but like not as much earnings to support that. And so they were under a quarter of the index's earnings. But today they've kept up. It's over 40% of the index in terms of market cap, those two sectors, but it's also a third of its earnings. So, we're getting a little bit valuation-led growth, but also there's a lot more earnings to support it than the last go around. And then this is just aggregate forward earnings for both those sectors. So NVIDIA and Cisco, this is actually something I wrote about at the journal as well. It's a fan favorite to compare the two. Cisco made the telecom equipment to build out the internet, and NVIDIA makes the GPUs for AI and lots of other things. You can see that the stock price for Cisco, we went from around 10 to 80 very quickly, whereas NVIDIA has gone from similar levels to around 135 or 125. It looks like NVIDIA's growth is kind of over exuberant, but I think there's a lot of charts to show why it's not necessarily the case. And NVIDIA's earnings are definitely more realizable than Cisco's. So if we look at the forward PE, I mean, Cisco absolutely skyrocketed from 20 or 30 all the way above 130, forward PE. Whereas NVIDIA, I mean, granted, I'm not going to call a valuation of 80 times earnings conservative, but they've been more bouncing around a 25 to 80 level, which it's just nowhere near what Cisco got to when their stock price accelerated that much. And NVIDIA is obviously the, the magnificent one within the Mag 7 or Mega Cap 8. We tack on Netflix to Mega Cap 8, given it's been a very good stock and Ed loves movies. You can see that the Mega Cap 8 as a whole, they're a huge part of the index. They're over 30%, but they're also 20% of the index's forward earnings. And then they're, 11% of forward revenues. Part of that is big tech companies have better margins. They get more out of each worker. It's a not very capitally intensive. Well, it is with data centers a bit now, but it's not a super capital intensive business models. And so, they get more out of each dollar that they earn or that they take in via revenue. And you can see the index with and without the Mega Cap 8. It's just, it looks similar, but it's just a huge gap when you take out the Mega Cap 8. Their growth has been pretty stupendous, up to $16 trillion in market cap now. And the forward PE, so yeah, is a 21 forward PE on the S&P, super high. It's 18 when you take out the mega cap 8, which is a little better. Again, it's if you look at history, it's still towards the top end, but it's a little bit better. And then you have a 31 on the mega cap 8. Again, they've been much higher quite recently. So whether that's reasonable or not or justified, I think the strong profit margins definitely help that story. There's more to go, which is why so many short sellers have been taken out to the woodshed, because you can't, when you've reached near 40 quite recently, it's tough to say it can't get there again. And then this is price to sales. It's just more of the same. So there are definitely a few similarities, but again, this is much more of an earnings driven market. I think one of the big risks that we see is if the Fed cuts rates, we'll definitely get much more of a valuation led market. Nvidia, tech, mega cap 8, all those valuations will expand. It'll start to be more 1990s flair, and meltups lead to meltdowns. But I think our broad story is that we're bullish for the rest of the decade. The roaring 2020 scenario looks really good. In Q1, on a year over year basis, we had 2.9% productivity growth, which is the strongest in a while, in at least 3 years. And then that kept unit labor costs down to less than a percentage point in growth, which keeps inflation lower, and it helps corporate profit margins, and it keeps real wages growing. It's really the magic pixie dust, I think is what Ed calls it, that keeps the economy churning. So we're gonna I think by the end of the decade, our target for earnings is 400 by 2029, and then once we get to a 400 forward PE, we're looking at 8,000 on the S&P 500. So that's our baseline scenario. Again, 60% subjective probability. The other two being the 1990 style melt up, which we think a preemptive Fed cut would be the catalyst for, and then the other 20%, which is unfortunately growing. We're starting to see more and more headlines about this, is a geopolitical kind of oil-driven supply shock that throws the economy into more of or weighs on growth, increases inflation. You can see that Israel and Hezbollah, those escalations, or that conflict is escalating and could potentially broaden out the regional war that's happening in the Middle East. And then there's shipping routes that are kind of thrown in a tizzy in the Panama Canal, and also in the Red Sea. Russia-Ukraine is still going on. There's always the Indo-Pacific issue to think about. So that's definitely something we're worried about. It's one of those, it can often be an unknown, but it's a little bit more of a known unknown today with the various regional wars and conflicts going on. But right now, roaring 2020 is what we're looking at. So yeah, I think I'm going to look at some of the questions you guys have, and please keep them coming. I'm happy to chat about whatever. For tomorrow, I'm working on something on the deficit. The CBO recently revised their fiscal 2024 deficit estimate from 1.5 trillion to 1.9 trillion, which is pretty substantial. Oh, I think someone's saying it's a little small, some of these charts. Should have seen that earlier, but we can go up to, we can go right here. And then if there's another chart, just throw it in the Q&A. But I'll chat a little bit about how we're thinking about the deficit. So the CBO revising up from 1.5 trillion to 1.9 trillion is part of a bigger trend for the coming years. It's pretty unheard of to run such a huge deficit during both peacetime and an economic expansion. And it's also why I'm not sure you're going to get a recession with 4.1 unemployment, because we're running a deficit to GDP ratio of 6.7%, which is kind of ludicrous and unsustainable for a variety of reasons. A few of the things that the CBO is doing is they're raising outlays because we're going to be spending more on Social Security, more on net interest. There's more aid to foreign countries. Medicare is getting more expensive. So our outlays are just increasing at a rate that's unsustainable and far above revenues. If you look at revenues that we take in via taxes, we're actually just going to be spending more on entitlement programs than we're even bringing in via taxes, let alone just overall spending. So it's definitely a new paradigm. It's a new normal. And I've seen plenty of sell side strategists or investors say, there's no correlation between the deficit and treasury supply with inflation or rising bond yields. But in reality, that's just because fiscal deficits tend to happen when you get those automatic stabilizers kicking in during a recession or during an economic downturn. So naturally, inflation looks weaker and bond yields fall during that time. And then when we're running tighter fiscal policy, it tends to be, periods of economic, boom. When revenues are rising from corporations and households, and we don't have to spend as much on unemployment benefits and other entitlement programs. But this is really a new norm, and the CBO thinks it'll take debt to GDP from around 100% today to 160% by the end of the year. If it for any comparison point, the EU is now taking France, Spain, and a number of countries into these kind of review procedures to get them to manage their fiscal deficits, and they're telling them to get it down to 60% of GDP. So we're well above that. It's really, I mean, it's unprecedented profligacy. Truly, I think there's plenty of people who say, from a very doomery perspective, though, that this is gonna go out of control and the 10-year yield is going to skyrocket to 6 or 7%, and the government will have to clean it up. I definitely think a debt crisis is what forces Congress to act and get a little more austere. But there's no one to say that'll happen soon in the next year or two versus some amount of years down the line. I think Treasury supply. There's a lot of demand from foreign investors and from domestic investors, and they figured out a way to kind of alleviate any bond vigilante action at the long end of the curve, which is just flooding the market with bills. We've been issuing a ton of Treasury bills for the past several quarters and years, and just hoping that investors keep eating them up, which they will. They're great collateral for Wall Street to kind of continue functioning. It's very financial market plumbing friendly. But when you have bills as such a huge part of your debt load, you're just subject to a ton of refinancing risk. Let's say the government went from 22% to a third of its debt is in Treasury bills. Well, a third of its debt is going to reprice every 3, 6, 12 months. And that's just way more market volatility for what is supposed to be the globally safest and most liquid asset. It would make the yield curve much more volatile, make the Treasury market much more volatile. And all in all, that's a huge negative for risk-weighted portfolios. So it looks like status quo, and for now, both parties seem intent on maintaining some of the 2017 tax cuts and keeping spending churning in whatever way they see fit. And so it doesn't really look like that deficit is going to shrink anytime soon, barring some fantastic amount of legislation or debt crisis to really instigate Congress to act. I'll take a couple questions. So I'm sorry about the charts. I should have zoomed in quicker. How do you factor in a potential sharp increase in taxes at year end 2025 if the tax cuts sunset? So interestingly, the SIBO in the Congressional Budget Office, in their estimates, expect all these tax cuts to sunset. The biggest would be the individual, lowering the individual rates. If that doesn't happen and all the 2017 tax cuts are extended, which I don't think the current administration would do, but they'll extend at least some of them. You're getting anywhere from a 4 to 5 trillion wider deficit through the next 10 years is what the SIBO is forecasting. Trump is kind of offhandedly mentioned he would raise tariffs to help, pay for, replace income taxes. That's kind of a bombshell policy to say. Who knows if that's really what he's thinking or would do. But yeah, I think the Biden administration has said they're only looking to increase taxes for households who earn 400,000 and up. It's like less than 5% of all households in America. So yeah, I think both parties are kind of converging on they can't raise taxes too substantially. They have to extend at least some of these tax cuts, but less revenues tends to be a little more inflationary. We'll see how either party thinks they're going to pay for those. Does your roaring 2020 scenario require the Fed to cut rates to a certain level? No, I actually think we think they're going to keep rates higher for longer. or what we like to say normal for longer. 5.5% on the Fed funds rate is pretty normal relative to history, outside of the kind of post great financial crisis aberration or whatever you want to call it. And we're looking at, at the long end, 2.5% on 10-year tips. That's quite normal. That's what it was pre-crisis, and reflects like a real growth expectation that makes sense. You tack on 2 or 2.5% inflation expectations over the long run, which is what the market has through this whole cycle, and you're looking at like 4.5, maybe 5% on the 10-year. We think between 4 and 4.5% is the most likely place it'll bob, perhaps with some flirtation with 5%, depending on how things go with Treasury supply. But no, I mean, I don't think the Fed should cut. We hope they don't. And if they do, that would up the odds of a 1990s style market melt up. The economy can clearly handle these rates, I think. And the whole R star argument of where is neutral, the inflation adjusted short term rate. I mean, it's kind of something you're there when you're there. If we keep getting real growth churning, the Atlanta Fed GDP Now model has 3% for Q2 still, which would be the 8th straight quarter of real GDP growth, and inflation is moderating towards 2%, then we're there. Then this is the interest rate the economy could handle. We're very services and high tech oriented. Everyone turned out their debt during COVID except for the government. And I think we can handle these rates no problem. Obviously, with some pockets that can't, like housing and the goods sectors are both definitely suffering from rolling recessions. Michael Brush, NVIDIA has a price earnings growth ratio of 0.95. Peter Lynch invented it, said this was cheap. Comments, we don't comment on individual stocks. I think something that we're thinking about NVIDIA is, the forward earnings for both NVIDIA and the mega cap 8 definitely look better. Like it's not such a hugely valuation driven market, but even forward earnings back in the 90s, let me find this chart. Forward PE ratios. Forward earnings. That's forward earnings share. I don't know where it is. Regardless, forward earnings estimates during 1999 were still high for infotech, and they collapsed. They didn't see the recession, and they fell, before actual earnings did. So we think NVIDIA's forward earnings estimates by analysts are definitely more realizable than Cisco's and a lot of the dot-com bubble companies that were popping up. I mean, it was like pets.com and all that stuff. I mean, NVIDIA is selling to very big tech companies. Their customers are also in the mega cap 8. And these are companies who have been investing in AI for years. And that demand is much more real, I think. Do I foresee anything special with the upcoming debate on Thursday? Is the fiscal issue going to be an important point? And also China? I don't know. I think we comment on politics from the perspective of just what it means for policy and markets. We'll see what they say, if there's any potential policies that are kind of unleashed or unveiled. I'd be interested to hear, what the GOP actually is thinking about doing with a lot of the tariff policies that have been coming out. But no, I don't know. It's kind of a wait and see. Do you think inflation will go higher from here? Freight cost is higher. Part of that's the Red Sea and Panama Canal stuff. UMich inflation expectations is higher. So something interesting is that, so first of all, UMich is like moving more towards online surveys, which is not a good, like you get worse responses. People tend to be more doomery online than to a real person, even if it is on the phone. But you can see in the CSI, the sentiment indicator, it tends to be much more inflation driven, whereas consumer confidence is much more dependent on the labor market. And we'll get consumer confidence tomorrow. I'm looking forward to probably writing about that in the quick takes. But no, I mean, consumer confidence has been really high, especially in current conditions, because there's been tons of job openings. There's been, less people are quitting, but we think that's kind of a positive. People are quitting because they're comfortable with their wages and they're happy where they are. And that feeds into lower job openings. But no, I mean, job openings per worker are still around, or per unemployed worker are still around 1.2 to pre-pandemic high. If you chart, I mean, we have a chart on this. If you chart inflation expectations from the consumer survey with like gas prices, they're pretty intertwined. So consumers tend to see, the biggest headline reminder of inflation every day, which is gas billboards when they're driving, and then bake that into their inflation expectations. But it's kind of a coincident indicator with wherever inflation's been versus like a really good predictor of future inflation. If you look at five-year forward break evens, which is what the Fed looks at, long-term inflation expectations look just fine between 2% and 2.5%. So that's what we're going with. And we still have 2% on PCE by the end of the year. We think shelter continues to disinflate. If you look at CPI without shelter, it's already at 2 or 1.9%, I think, for core. So we're waiting for some of those, oddballs like auto insurance and health insurance and home insurance to kind of come down. Shelter is a huge part of CPI. That's disinflating. You can see it on the 3-month basis versus the 12-year year-over-year change. It's more than a percentage point below for both OER and rent of primary residence. So we're pretty sanguine on inflation. Fiscal deficits are an issue, but that's more of a longer term concern. And if we can grow nominal GDP and remain really strong in terms of productivity, we can manage that debt and not let it get out of control. So that's kind of how we're thinking about it. But yeah, that's it. It was a blast to host while Ed is hopefully enjoying his time in Scotland. And yeah, we'll see you here next week. Thanks everyone for joining. Bye.